Overtrading is a trap many traders fall into, especially when they're new to the game. But what really drives this behavior? Today we're digging into the three main fears that fuel overtrading. If you think you're immune, think again. Even seasoned traders have been caught in this cycle. If it hasn't happened to you yet, it's only a matter of time. So let's dive in and learn from those who've been there before it happens to you. Imagine this, it's 9:15 a.m., Nifty is sitting at 25,000 and you're ready to make your first trade. You think you've got the perfect setup. The first candle of the day is green and looks promising. So you jump in convinced the market is going up and buy Nifty 25,000 call options. But just as quickly, the next candle turns against you and the price of your call option drops by 30 rupees. Now you're down 20% right off the bat. Panic sets in. Should you buy more to lower your average price? Should you sell and cut your losses? You hesitate, and then the premium drops another 20 rupees. You stop out, frustrated, just 15 minutes into the trading day. Then, as if to mock you, Nifty starts climbing again after you've exited. Desperate not to miss out, you jump back in, buying the calls again. But Nifty falls once more, and now you're down another 30 rupees. You stop out again, cursing your decision to re-enter. This cycle repeats throughout the morning. You've lost 120 rupees on the premium of those calls, even though Nifty hasn't moved at all. It's like you've been tossed around in a washing machine. Later, a perfect setup finally forms, exactly what you were looking for. Nifty breaks out and surges higher, just as you originally thought. But by now, you're emotionally and mentally drained, too exhausted to enter the trade. The market moves up without you. How many times has this happened to you? What is overtrading? Overtrading happens when traders take too many trades in a short time, often without a solid plan. It's like getting caught in a trading frenzy where you jump in and out of trades constantly, take on more risk than you should, chase the market impulsively trying to catch every move. There are three fears behind overtrading. According to trading psychology expert Mark Douglas, new traders often start out confident but quickly become scared as they encounter the realities of the market. This fear drives overtrading and usually shows up in three ways. First, fear of missing out, or FOMO. You see the market moving and panic that you'll miss out on profits, so you jump into trades too early without waiting for the right signals. This is exactly what happened to our trader earlier, jumping in before the market confirmed the setup. Second, fear of being wrong. When a trade starts going against you, you might exit too soon, afraid of being wrong. Or if you're in a small profit, you might close that trade quickly, scared that the market will turn against you. Example, you enter a trade, but the market moves against you. Instead of sticking to your plan and waiting for your stop loss, you exit early only to watch the market turn back in your favor. Third is a fear of loss. Losing money is scary, and this fear can push you into overtrading, trying to quickly make back what you lost. This can lead to more reckless decisions and deeper losses. Example, after a few losing trades, you feel desperate to recover your losses. You start taking trades without proper analysis, hoping to get lucky, but end up losing even more. These fears are common among traders. Recognizing them is the first step to overcoming them. In our next few videos, we'll dig deeper into strategies to develop a more disciplined approach to trading Nifty options. So remember to subscribe to this channel and like our videos. Remember, trading is a skill you can learn and improve. See you next time.